Hello guys, my name is Akindele Ibrahim. I'm a chartered accountant. I'm just here to take you on strategic financial management. aka SFM. Aka SFM. Most students did not like this particular course in at ICANN level or being the ECCA level financial management. So this in my video, I'm going to explain one of the topic in SFM for today. Please don't be scared. Don't be scared about SFM. SFM is very simple and straightforward. So I will just take you on the cost of capital briefly. Cost of capital, giving you maybe I will just talk about the equity part of it. In my next video, I will talk about the capital asset pricing model and all that. So, distinguished ladies and gentlemen, okay, let's get started. Oh, cost of capital. Cost of capital. Help. Some students will say, what is cost of capital? What is cost of capital? Cost of capital is the required return that investors are expecting from their what? From their investments. Now, what investors are expecting from their investment could be dividend or capital appreciation. Now, cost of capital is of two types. Now, before I talk about cost of capital, let me quickly talk about what brings about cost of capital. Now, if we can remember that financial manager, who is a financial manager first? A financial manager is a person that ensure that the resources of an entity is fully what utilized. What it means is that it ensures that these particular resources are meant for what it are used for what it is meant for. Now, a financial manager has two functions, has three functions rather. One of the function is what we call investment decision. Investment decision, sorry, investment decision, function, function, function of a financial manager. Please don't mind my handwriting. Manager. So one, we have investment decision. Two, we have financing decision. Three, we have dividend, what? Dividend decision. Now, I just want to talk about what bring about what? Cost of capital. Now, what bring about cost of capital is the function of a financial manager. Now, investment decision. When you talk about investment decision, a financial manager make investment decision. That is capital what? Capital projects. That is an investment a financial manager ensure that this particular project before a company or an entity can be able to embark on this particular project, that project should be what? Viable. The financial manager should see that okay, he has done his feasibility study and he has ensured that okay, this particular project is going to be what? Viable on the long run. So that is what bring about what? What I'm actually want to explain what bring about cost of capital. Now, this is what capital structure. Capital structure. Now, as a financial manager ensure that make a financing decision. Now, to a firm, either to go by equity or to go by what? By debt. So this is what bring about what? Cost of capital, which is what? Financing what? Decision, which is what? The capital structure. Financing decision has to do with okay, this is a project, this is a capital project, we have a project, and how do we finance this project? Now, we can finance this project through equity or what? Or debt. So that is why we have what we call cost of what? Capital. Definitely it is going to cost the organization either going by debt or by going by what? Equity. So now dividend decision, it is based on the what? The entity policy on the what? How to distribute what? Dividend. Now, this is not our topic for today. I'm just trying to explain what bring about what? cost of capital. Cost of capital is telling us about financing decision. Now, let's quickly define cost of capital. Cost of capital is the minimum return that the investors are expecting from their what? From their investments. Now, cost of capital. Now, what it means is that as an investors, it could be investors or lenders. Now, cost of capital is divided into two: equity, debt. Now, from the definition, what investors are expecting? Investors are expecting dividend from their what? From their investment. While the lenders are not expecting dividend from their investment. You must what? You must pay them their interest as and what? As and when due. So the cost of capital now divided into two: the equity, that is the investors and the what? And the lenders, which is what? The debt holder. So which means that when a firm want to source for a finance, they can source for a finance in two ways: either going by equity or going by what? By debt. Now, this is equity and this is what? Debt. Cost of capital is divided into two class. Is divided into what? Two. Now, under equity, now to calculate cost of equity, we have what we call dividend valuation method. No, now to calculate cost of equity, method of calculating cost of equity is dividend valuation method, capital asset pricing model, capital asset pricing model. 3, Modigliani and Miller. Modigliani and sorry, let me quickly clean this place. Modigliani and Miller. So when we get to adjusted present value, we talk more on Modigliani and Miller. Now, under this dividend valuation method, from the beginning, we are talking about capital structure, a function of a financial what? Manager. Now, which they make financing decision. That is, we have a project. How do we finance this particular project? We can go by equity or by what? By debt. A financial manager will suggest to the organization that, okay, should I go by equity or by what? By debt. Mind you, before I continue my explanation under the equity, under the cost of equity, I would like to explain as a financial manager, that the cost of equity is always higher than the what? The cost of debt. Why? Because the equity holder are expecting what? Are expecting dividend from their what? From their investment. They are expecting return. It may not be return on what? On their investment. And this return can be divided into two. What are the returns? Either by dividend or through what? Capital appreciation. Capital appreciation means what? Increase growth in the what? In the share price. Growth in the what? In the share price. So they are expecting either dividend or capital appreciation from their what? From their investment. Which means that if the company did not make a profit, there is no how they can't get their what? They can't get their money. They can't get their what? Their return. They can't get it. So that is why the cost of equity is always higher. For them to be able to borrow money from the what? They need to, when they borrow the money from the investment, they will pay higher what? Higher cost. Now, the equity holders are the risk takers. Yes. Now what I'm explaining now is the reason why the cost of equity is higher than the what? Cost of the, or we call it characteristics of what? Cost of equity. Now we can say that, okay, the equity holders are risk taker. They take a risk. You can see. Let me quickly take you to what we call the NGS. The NGS, which is the stock market. When you look at the NGS, as an investor, you buy GTB bank shares now. NGS market is too volatile. So they are risk taker. So they may actually make a loss at the end of the what? At the end of the investment. So they are what? They are risk taker. Another characteristic is that during liquidation, they are the last people to be paid. They are the last people to be what? Equity holder are the what? are the last people to be paid. Because why are they the last people? Because they are the what? Investors. They are the what? They are the shareholders. Now, debt holder will be paid their interest as and what, and their principal as and what, as and when due. So what I'm explaining here is like the characteristics of what, or cost of what, equity, or why cost of equity is what, higher than what, the cost of debt. Why? Because a debt holder will receive his principal. You okay, for instance, now you lend me 15 naira. Now this 15 naira that you lend me, okay, the rate is 5%. So at the end of 2 years, or at the end of 3 months, you are going to pay me. I'm going to pay you your interest and your principal, right? I'm going to pay you. So debt holder, whether the company make a profit or not, you are going to pay them both the what, interest and what, and the principal. So that is why the question may say that, okay, why cost of equity? Why? Give reason why cost of equity is higher than what, the cost of what, debt. You can give them. They are what, their equity holder are what, are risk taker. One, during liquidation, they are the last people to be paid. Three, their dividend is not what, it's not fixed, because it fluctuates. It depends on what, the market, or the what, the profit. Now let me quickly now just explain this. Now, just under the dividend valuation method. Now, dividend valuation method is telling you that under the cost of equity, there are three methods of calculating cost of equity. Cost of equity, it is a cost to the firm, why it is a return to the what, to the what, to the holder, to the investors. Because investors is lending the company money, right? Is lending them funds that let them use it to what, to finance a what, a project. Do we get? Is an investor give their shares, or give their money, to their funds, to the what, to the company. So definitely it will be a cost to the company. It will be a return to the what, to the investors. Are we together, please? Are we together? So that is why we want to get dividend valuation method. What is the cost of equity under the what, dividend valuation method? Now under the dividend valuation method, we have dividend when there is a growth, when there is a growth in dividend. Or let me start with when there is no growth. Sorry, please. Let me start when there is no growth in dividend. When there is no growth. When there is no growth. Dividend, or let me say dividend without growth. Dividend without growth. Now what it means is that a shareholders will collect, if the dividend policy is to share 2 naira at the end of the accounting period. At the end of the accounting period, what it means, dividend without growth, what it means is that an investor will collect a constant dividend throughout the what, perpetuity. The dividend is not going to what, it's not going to change. So that is dividend without what, growth. As an investor, you lend the company money for you to buy shares in that particular company. They will use it for what, for business, to run their what, for business. Maybe they want to use it for a project or not. You are, as an investor, you are expecting a return on what, on your investment. So the return, don't forget that I said the return could be dividend or what, capital appreciation. So let me just stop it here. And dividend without growth is calculated as cost of equity is equal to dividend paid or the current dividend. We can call it current dividend. current current dividend divided by market value SD. I will stop here. Now in my next video, I'm going to explain dividend with growth and capital asset pricing model. You can see studying financial management is something that is not difficult, it's not hard. You need to just get the right person to put you through on this particular course. Now, cost of equity, if you want to calculate cost of equity under the dividend without growth, don't forget dividend valuation method is divided into two: dividend without growth and dividend with what, growth. Dividend with growth. Dividend with what, dividend with growth. Now cost of equity equals to current dividend divided by what, market value SD. Now the question is, what is market value SD? Now we have what we call market value cum div and market value SD. Now market value cum div means that the dividend has not been paid to the what? To the investors. Cum div, in a question you will be told that okay, the dividend has not been what? Has not been paid. That is what we call cum div. Now why market value SD means that the company has actually what? Paid dividend. Now for instance, in a question, how do you determine, for instance, if the dividend has not been paid? So now how do we determine the market value SD? For instance, we are given in a question that okay, the market value of this company, the market value, there is a market value cum div of 50 naira. Now how do we determine market value SD? Now how do we determine market value SD? Market value SD is equals to the nominal value minus dividend outstanding dividend. The nominal value of that shares minus what? Outstanding dividend. You know, outstanding dividend, the dividend that are yet to be paid. Now in my next video I will talk more on dividend with growth and capital asset pricing model. So I'm sure you are going to get it will be an interesting one for you. Please like and share the links to your colleagues that want to write strategic financial management at icon level, and also those that want to write financial FM in what? In ACCA. Thank you so much. Thank you so much. Thank you.